apropos liquidity, organizational form and liquidity evidence from closed-end and open-end municipal bond funds with John Chalmers from University of Oregon, and then our discussant will be Steve Winterstein following him. So thank you.
So I couldn't have asked for a better introduction, John. Thank you very much for the liquidity introduction, and its importance. I even have a few liquidity jokes in here, so I hope you hope you'll get those too. But before I start, I guess one thing I wanted to just say is to thank the organizers for putting this conference together. From an academics perspective, this is a great opportunity for us to learn an awful lot about things we don't know because we don't experience them every day. And I'm going to go on a little aside here, back to my graduate student days. One of the sages in our department, who's the editor of one of the academic journals, often said to the new PhD students, he said, the most important journal to read is not the Journal of Financial Economics, which if I ask for a show of hands, I bet none of you have ever read other than the academics. The Journal of Finance or the Review of Financial Studies. It's the Wall Street Journal. You're welcome, David. But he did say that, and the best topics come from that. And so this is an opportunity for us to hear from you. Are we doing something that makes any sense, that's helpful, that has policy implications that we should take seriously? And so I welcome those comments and that inspiration for new ideas. So this paper is a brand new paper. It's a mess. I apologize, but we got it done in time. It was not done at 10:30 last night. We were in a week ago, on time, on schedule, just not well done. Okay, but it has the ideas in it.
Don't oversell it.
The ideas are in it. So this is written with Jay Wong, who's an associate professor at Oregon, also, and Jingyun Yang, who's now she's a recently graduated PhD student, and. So let me start out with some very 1990s graphics here. So if we start, our basic idea, let me just go back to the title. Organizational form and liquidity, evidence from closed-end, open-end municipal bond funds. So let me first talk a little bit about open-end and closed-end municipal bond funds. So there's a huge difference in the way you manage one of these funds, and you all know much more about this than I do probably, but just to make sure we're on the same page. On an open-end fund, when somebody redeems their shares, the fund manager has to sell something, often holds some cash, but has to sell some of their assets. And so on that left diagram, the left circle, on Monday, our assets are big. On Tuesday, somebody leaves the fund, our assets are smaller. We have to get rid of something. Closed-end funds aren't like that. So on Monday and Tuesday, they have the same number of assets because when somebody leaves that fund, they have to find somebody else to take their place. So we have this woman walking in with a bag of money. She gives it to the person that's leaving, but the money stays in the fund. So there isn't a need to liquidate. Okay, and that's a big difference when you think about what the fund manager has to do on a daily basis. So finance for 1,000, Alex. I just spent 2 weeks with my mother-in-law, and one of our bonding opportunities is watching Jeopardy. So that's the inspiration here. Finance for 1,000, Alex, an explanation for virtually any asset pricing anomaly. What is liquidity, Alex? Okay, so this is the answer when finance people don't know the answer, okay? Just to kind of put it out there. So the municipal bond market, and we've talked about this in the earlier sessions, is a market that's commonly held up as an example of an illiquid market that is a big market. There are few trades in any particular asset. And we know that from lots of work, but especially Harrison POR was one of the first to really show that in very extensive data analysis. And then trades are relatively expensive, especially those retail trades. So a theory for why we see closed-end funds is out there among the academics, and I'm going to just cite one of them, but the idea is that it allows investors to more efficiently own less liquid assets. So if you want to buy an illiquid asset, you do it as John Chalmers. I want to go out and buy $25,000 worth of City of Eugene bonds. Or do I want to go buy a closed-end fund that specializes in Oregon bonds? So Cherkis, Seiji, and Stanton have this paper where they say the value of a closed-end fund really comes from three parts. First of all, the NAV, so the value of the actual assets. Second of all, a set of capitalized liquidity benefits. and it contributes to the value, less the manager's fees. And so there's some factors in the municipal bond market that suggest that these capitalized liquidity benefits might be quite large. So first of all, in contrast to equity markets, a big trade of municipal bonds is cheaper than a small trade of municipal bonds. So on a percentage basis, you lose more value by trading big lots rather than small lots. If a fund knows it can hold a bond to maturity, the fund doesn't have to trade absent leverage, so it will never have to incur some costs if it's a closed-end fund without leverage. Closed-end funds are exchange traded, while municipals are traded OTC. So there might be some benefits there. I don't actually know the answer to that, but my guess is it's a little bit cheaper to trade the closed-end fund than it is to trade the underlying assets. Okay, so what do we do in this paper? So do closed-end funds hold less liquid assets? We asked that question. Does closed-end fund leverage interact with the liquidity choices? And then do closed-end funds earn a liquidity premium? So this would be the idea that these funds are doing this for small investors so that you can earn a little bit extra return for taking on less liquid assets. So again, the results in here are preliminary, but we're pretty confident about some of them, and I'll point out the ones we're less confident about. So we have data in the paper about pre-crisis and post or during crisis data. I'm going to focus on the pre-crisis data, and then I'll make a few comments about what we find during the crisis. But we would expect that returns during the crisis for less liquid assets should be relatively poor compared to more liquid assets, and that's largely what we find. So before we start, I'm gonna also simplify my discussion and focus on just one of our measures of liquidity. We have four. The one I'm gonna focus on is basically a bid-ask spread, or a realized bid-ask spread, or a dealer markup. So we basically just take the price of a sell minus the price of the buy, divide it by the price of the buy. So it's a percentage of the assets that were expended to make that trade. And what I'm showing you here is a chart from a different paper. And this paper is with Jay Wong also and another one of our PhD students. And what this just shows, and this is right around, I don't have the laser either, Dan. I didn't think I had a parole officer. But, just around the period from 2003 through 2006, the levels of those bid-ask spreads or those markups, and this the top blue represents the smallest trades, so on the order of trades that are 25,000 and below. The bottom, the purple, represents trades that are $1 million and above in par value. And what you see here, and the left-hand scale is in basis points, so you can see that these markups for the biggest trades are on the order of 30 to somewhere between 30 and 60 basis points, where for the retail, the super retail, if you will, those blue trades are on the order of 240 basis points, certainly at the beginning of this period. So again, that's just to give you a sense that these markups vary dramatically by trade size, and at least in the muni market, these look large compared to what you would see in stock markets. Okay, so in terms of the data we're using in this paper, and there's a lot of it, so we have 712 open-end funds, and we have 296 closed-end funds. The average size of those open-end funds is $660 million. They have, on average, zero leverage, on average, 200 different names, on average, a maturity of 13.7 years, annualized quarterly returns of 5.32%, and 3-month markup is an average of 0.39, so 39 basis points. The closed-end funds, on the other hand, are a little bit smaller. They have leverage on average, although there are several of these closed-end funds that don't have leverage. They have fewer holdings, 135 versus 200. They have longer maturities, 19 versus 13. And they have higher returns. And they also have higher markups. So this is 0.75. Unlike John's presentation, this one isn't helped. The cut is cutting my 7.5s in half. But so at least at first glance, these are just summary statistics, averages of these data. We do see things that are consistent. We see higher returns, we see more risk taking, we see fewer holdings, and we also see higher markups. Okay, so apologies for the small font here, but so this is the answer to the question, do closed-end funds hold less liquid assets, and does leverage matter? So these are the first two questions that I asked, and the answer to both is I think yes. So if we look at the difference between these two sets, these are 12-month round trip transaction costs. These are just measured over a 3-month interval. I'll just focus on this right side. And that top green circle up at the top, you can see is a dummy variable. For those of you who aren't statisticians, dummy is not a pejorative term here. Dummy is just a constant that we take out. I just want to make that clear. And so if we look at this far right column, number 5 on the far right, that 0.191 that has the 3 stars by it suggests that the illiquidity of the bonds held by closed-end funds is higher than it is for open-end funds by that constant amount. Okay, and again, we're talking about a bid-ask spread that has an average of something on the order of 1%. Now, if we interact that closed-end fund dummy with leverage, we see that it goes down. So if we're talking about a closed-end fund that has leverage, they're going to hold less liquid bonds. So it does look like kind of we're seeing what we expect to see, which is that if you have leverage, you have another reason why you might have to sell your bonds when you don't want to. And so we're finding that. Now, the third question that I asked was, do closed-end funds earn a liquidity premium? And our answer is we're not sure. Okay, we need to do some other things to make sure, but certainly the simple statistics looked like they did. And what we're trying to do here is we do find some evidence here that, again, circled in the green box at the top, that closed-end funds do have higher returns. And we do find that the markup, at least in the 12-month markup calculation, is statistically related to higher returns. So if they hold less liquid bonds, they do seem to have higher returns. And then we do find a leverage interaction, which is that the closed-end funds with higher leverage do also earn substantially higher returns, which is not all that surprising. Obviously, they're taking more risk because they're borrowing short, investing long on the term structure, and that's an old strategy. And then finally, my last bit of evidence that I wanted to talk about is what we do here is we say, let's take all the closed-end funds, and let's take all the open-end funds, and let's take a weighted average of their monthly returns. And we're going to subtract the open-end fund return from the closed-end fund return and see what that difference is and what it's related to. And so we're going to break that up into all of our funds, and then we break it up into a few subsets. But the basic idea here is what is explaining the difference between closed-end fund returns and open-end fund returns. And if you look at our variables that we're going to use, think of this as the CAPM, where we have risk factors that we're estimating their influence on the returns. We have muni excess returns, so that is, we also have stock market excess returns, which don't seem to matter in any of these regressions. But the muni excess returns do, and very strongly across the board. We see the credit spread, which is a difference between the AAA and the BBB returns. And then we see the term spread mattering quite a bit. So if we're going to go out and explain closed-end fund returns relative to open-end fund returns, it looks like those three factors matter regardless of this comparison that we use, which is what we would expect. And what it tells us is that probably what's going on with the muni excess return is that's a leverage impact, right? So I'm taking more muni risk on the term structure, so that's what we're picking up in terms of this distinction. The credit spread, these closed-end funds are taking on average higher credit risk. That's what is implied, at least on average, across these different cases. And then the term spread, they're also taking more term structure. They're buying out longer, and we're seeing that manifest itself in these term spread returns. The important, actually, takeaway from this table is actually the top row, though. I mean, those are important because that helps us understand what kind of risks are being taken. The constant term up here tells us the alpha, okay? And so a couple of our subsamples, National Muni Long And single state funds, that's a statistically significantly negative alpha. The other ones, it's not statistically significant, however, it is negative, except for the Muni National. So it suggests that the fees are quite a bit higher, and if we do this with gross returns rather than net returns, so we add back the fees, none of these are significant. So it seems like the fees are what's driving that negative alpha in a large part. Okay, I have 21 seconds left. So I'm going to call these preliminary findings. We find convincing evidence that closed-end funds are holding less liquid securities. We find that closed-end funds that employ leverage are also going to hold more liquid securities. And at this point, we're still working on kind of whether investors are benefiting from a liquidity premium or whether they're just receiving higher returns for risks that they're taking. And so that's work in progress. So very much look forward to comments and questions, and thank you very much.
I don't need a computer. I'm just going to work off my notes here. Actually, had a great time working with John on this paper, and we actually got to know each other over the last month or so, and we had a lot of fun going back and forth, and we had more discussion than I thought we would have. But John, the paper, I thought how I would describe it, I think John has potentially a piece of heavy artillery, very potent heavy artillery. My problem is I think it's pointed at the wrong target. So let me say at the outset, the studies that and by the way, there are no punches being pulled here. John and I, we've hashed this out over multiple conversations, and it's a good friendly exchange. I think the more relevant conversation, rather than closed-end fund versus open-end fund, is the new 22E4 rule on liquidity for mutual funds. And what I'd love to see this study focus on is how you ascribe liquidity because as I'm sure most of you know, the SEC, starting in December, is going to require funds to categorize their securities in terms of buckets of liquidity. And this seems like it could be a really a seminal piece of academic work on that very topic. And so I would encourage them to at least think about reworking or starting a different topic on 22E4. So John touched on their measures of liquidity, and I think this is probably where he and I differ on opinion. And I argued with John at first. I said, no, you're using price. Price isn't the right thing. You should be using yield, because the market looks at yield, not prices, because the dollar value of an 0.1 basis point out in the 30-year part of the curve is different than the dollar value of an 0.1 in a 30-day piece of commercial paper, for example. So I began my argument saying yield, and then I got to thinking about it, and I thought, no, actually, yield and price are exactly the same thing. And I think John was in part responsible for making me say that out loud when we were, and they are. They're describing, well, a little lecture. We're describing the same thing in different terms. Yield is price and price is yield. And in my judgment, when you're looking for liquidity, either one of those is wholly insufficient in describing liquidity. Why? Well, the first thing that I think that John controls for is maturity, and we've seen that in the paper, and we've had this conversation. Maturity in the municipal market means very, very little, because it's a no-call 10 market. In other words, every new deal that comes to market, practically every new deal that comes to market, has a 10-year call. And actually, they're coming out with 6- and 7-year calls now, and those call structures are shortening because of the removal of advance refundings. But the point is, optionality matters. Optionality matters a lot in a market, and so maturity or prices or yields are insufficient in order to capture that optionality that we see in the market. So what I'm recommending to the authors is that they reconstruct what they're solving for, what they're defining liquidity is. And they have 4 inputs, as John mentioned, they have 4 inputs. Another one, which is suspect to me, is what they call bond zero-day trades. In other words, the frequency with which a bond trades. And we know experientially that when a new deal comes to market, it trades very actively for the first 2-3 months, and then it goes away. That's our terminology. It goes away, meaning it finds its way into investors' hands, and then it trades by appointment only. And so looking at the frequency with which a bond turns over is probably not a great measure of liquidity. You know, the analogy that I would use is the last time Starry Night, Van Gogh's Starry Night, changed hands was in 1941 when MoMA acquired it from an estate. I would not describe that as an illiquid painting. It's very liquid. If it were up for sale, estimates say it would probably transact at around $100 million, and you would have a huge number of bids. So looking at the time something transacts doesn't necessarily measure its liquidity. But back to price. So how do I think the right way to structure a measure of liquidity? And again, we've had this conversation. What I would recommend is using an OA model, option adjusted spread. So I would look at, and I know that there are those out there, and I'm not going to shout out at vendors, but there are those out there that do an excellent job at an iterative process in determining volatilities, and we can come up with an optionless and an option curve, and then we can calculate the OAS and the OAD, the effective, the option adjusted spread, and the option adjusted duration of a bond. And that really captures its interest rate sensitivity, and that accounts for optionality across the curve regardless of the structure. So here's how I would calculate that spread, if you will. I would take the OAS per unit of OAD. In other words, you're looking at a unit of spread per unit of interest rate risk. OAS per unit of OAD. A simple way to do that would take the bid offer OAS minus the offered side OAS and divide it by the bid side price. Duration isn't going to change that much with a couple basis points of spread. And so then you can come up with and I'm not a statistician, and Dr. Calatay is sitting in the audience, and Chalmers is up here going to ridicule me, I'm sure, but it's a way to standardize or normalize that spread across the entire term structure. You're coming up with a number that, irrespective of whether it's a 10-year bond with a 3-year call or a 15-year bond with a 2-year call or whatever you're looking at, you have an OA, you have a measurement of liquidity there, you have spread per unit of risk. Of interest rate risk that you're taking, and I think that's an important difference, and I think that's fundamental to the entire study. I don't think maturity, I don't think price, I don't think yield cuts it. I think you need in a market that's rife with optionality, you need something to account for that optionality. The only other things that I would say are that. Two more things. I think that they need to control for state and sector. We had this conversation. There are 22 sectors in the municipal market. We have 50 states, 5 territories in the District of Columbia. We need to control for these things because they trade in different stratospheres. Cal trades different than Oregon, for example. Cal trades different than New York. New York trades different than Georgia, different tax structures and so forth. And we have a multiplicity of sectors, and they need to be accounted for. The last thing that I would say is what we're describing is liquid or not liquid. If we're asking the question, why, then you can start to do performance attribution, a factor-based performance attribution where you're loading on these factors of sector, ratings categories, coupon, which I know you control for, and you can take the full term structure, you can use key rates then, or use D1, D2, D3, a parallel shift, a steepening, flattening, or twisting of the yield curve, convexity, yield, and then look at all these other factors. You can load on them, you create a model, and you get your residual, and then you can actually look at why. You can tease out the sources of returns and say why certain funds are performing better than other funds. I think to look at price and to ascribe liquidity as a reason, I think that probably falls short of the mark. So with that, I have a minute 33. I will cede my time. Are you sure?
Well, we'll start our civil question, answer, and perhaps ridiculing this portion. So, do we? Let's get George. You have a question?
Yeah, thanks.
Could you wait for the mic? Say your
sorry.
affiliation.
Yeah,
State it as a question.
Sure.
Please.
There's something that really confuses me. I guess that's a question. About the liquidity
That was
component.
a statement, George. Just to be clear.
I took it as a stab. Thank you. The liquidity question, which is two parts. One, the open-end funds did use leverage. They did it through TOBs, and I see Steve nodding. And I wonder how different the two were in the real world. There were open-end funds using 99-to-1 leveraged TOBs that vanished in sometime around the end of '07. The second part is the crisis that the closed-end funds went through in terms of their leverage, namely the preferred stock, which ended up creating massive lawsuits. And I don't know how that affected performance. I'm wondering if you looked at any of that.
So first of all, the TOBs I'm aware of, and but I wasn't as aware that they were primarily in these open-end funds, and so we need to look at that more carefully.
But I think more in the open-end funds because they didn't.
Because they couldn't do the other way, yeah. But the data we have is from Mergent again, and so we're reporting what they're reporting, but the TOBs weren't counted as leverage in the way they counted it. So we need to fix that, and that's very helpful. I think with respect to the second question was the crisis. So yes, so our closed-end fund performance, and I focused on the pre-crisis performance, is as you would expect. The closed-end funds do very poorly during the crisis period as they have to unwind these illiquid positions as they're forced to, they have no funding anymore with the adjustable rate preferred drying up. So I in the presentation, I kind of focused on the pre-crisis period, but during the crisis, you see the types of things you would expect to see. You would see underperformance of assets that are going to get killed in a crisis. So,
Dan, did you have a question here? Can we wait for the microphone?
Two questions. One is that
could you state your affiliation, please?
Oh, Dan Lee from Federal Reserve. One question is that you said that closed-end fund hold the type of securities that are more illiquid, like they have longer durations, they have a higher markup. Have you looked at their credit quality distribution and also issuance size? Because those are highly correlated with round-trip transactions, right?
yeah, we try to control.
You got to hit that button.
Did it go off?
It goes off after 20 seconds.
Oh, okay.
Trying to save money here on electricity.
We tried to control for a number of those things. I also kind of skipped. We did, and Steve mentioned it. We have 4 measures of liquidity, which we used as variables to identify whether or not the funds hold less liquid assets. And so we have that on the left-hand side, and then we kind of have the factor analysis, which I showed at the very end of my presentation, which tried to control for performance attribution, really. And so the short answer to your question is we need to do a better job on duration. But we did control for things like maturity. So
It would be just interesting to know that what are the dimensions they add to the illiquidity. Are they primarily loading on high yield bond, or are they going to the really tiny municipalities? What are the dimensions they play with? And the other question is that you use the return on closed-end fund, right? Instead of unlike mutual fund, it's actually NAV, it's the prices of the underlyings, whereas with the closed-end fund, it's the prices that's traded. So there's a component of this premium versus discount, and that's typically in the academic literature, people use that as a sentiment measure, right? And it would be interesting to know, like, if you tease out that sentiment piece and just look at underlying prices, what do you get in terms of return?
We did do an analysis where we took the holdings themselves and we looked at their actual returns. The problem with that, or the reason that I worry about that a little bit, is that we actually don't have every holding. We only do it if we have 90% of the holdings of the individual funds. And then the other problem is then we have to figure out what each of those is worth. And we're using EMA data, so we're going to see, we're going to see a bond trade once a month, and we're going to have to come up with a price. So we do try that with holdings-based returns, and we do actually find, arguably stronger evidence that there is a return premium in those holdings, in the illiquid.
John, can I get the gentleman behind you, John? We'll get to you next. Thanks.
Bob Cherenka, University of Illinois, Chicago. The thesis of this paper is that there's a liquidity problem with open-end mutual funds, right, that basically the closed-end mutual fund is solving. The question I have is, why don't big mutual fund companies like Fidelity and Vanguard solve this problem by collecting, having a pool of resources that would have solved these liquidity problems for any one of their funds? Law of large numbers would suggest that a lot of that liquidity problems could be smoothed out over a number of large funds.
Great point. We do see, and this is actually in Jing Yoon's PhD thesis, that actually, and it's in some of the results here, that large families hold more illiquid bonds, and we do see them able to move the bonds across the different funds on their platform. And so to some extent they do, but I think it's about 30% of closed-end funds are muni funds, which also tells you something about organizational form and what may work.
John?
Thanks. I was just thinking about the results where you do the sort of difference decomposition right near the end, where it looks like you have very high R squareds, and I think you could use that in a different way by in some ways taking that difference or the return attribution and taking it seriously as like a style decomposition and running that regression with instead of focusing on the alphas, run it without a constant and force all the coefficients to sum to 1. And that would give you sort of what the percentage of the return is attributed to the various factors. And that would allow you to put in something like VIX or something that might be correlated with the optionality underlying the portfolio. And you could sort of do things like that, even with the iTrax or iTrax kind of squared, maybe not in the 2001 to 2007 period, but you could put a lot more stuff on the right-hand side in terms of performance attribution.
Okay, good idea. Thanks.
Dan, you got a question here?
I want to push back as civilly as I can. But I think if we define liquidity as the ability to convert a bond into cash, at minimal discount very quickly, I think that the liquidity of any instrument is not necessarily just a standalone characteristic of that instrument. It's a characteristic of whose portfolio it lands in, right? So if you want to predict whether a bond will be a bond that you can sell with minimal discount, if it lands in a portfolio that is sort of an active trader, it's going to tend to be more liquid. It will have a higher level of latent liquidity, even if you don't see it trade, because it's held by somebody who's deeply engaged with traders. And so it's not, you could take the same bond, precisely the same characteristics, but if you put it into sort of a very active portfolio, it will tend to be a more liquid bond. So I just want to push back on it seems in the background as an assumption that liquidity is a characteristic of the bond, the instrument itself, rather than a characteristic of the bond investor match.
Excellent point. So, I mean, the bonds that another way to say what I think you're saying is the bonds that are purchased by these funds are inherently going to be more liquid than bonds that are not purchased by these funds.
So actually, this may be a silly thought, but I was wondering if you could look at funds that own Puerto Rico bonds and assuming that they are illiquid or at least distressed, see if they were owned disproportionately by open-end or closed-end funds, kind of to Dan's point that somebody that could bear the illiquidity of a Puerto Rico bond would have a higher propensity to own it.
That's a great point, Rich. And if it depends how we define liquidity. One of the most actively traded bonds when they came out were Puerto Rico 8s of 38. they were and they were junk, and they were the most actively traded, piece of junk that you could find. In fact, they were more often traded. They had more volume than any other CUSIP on the street for a long time, and yet none of us would describe that bond as a liquid bond. At least not today, we wouldn't.
Any other questions? George, one last quick question. We got a couple minutes. And we want to get to the real exciting panel that I know you'll have a question on.
One of the tricky things for me in terms of open versus closed end is that the closed end don't have to sell because there are no inflows and outflows. And I'm wondering how that affected your comparison between the closed end funds and the open end funds.
Well, that's kind of our expectation. That's really where our hypothesis comes from, is that these closed-end funds are created in maybe one of the reasons they're created is to exploit the fact that they can hold less liquid assets and earn higher returns for a liquidity premium that they earn there. And I think again, given that so many closed-end funds are muni funds, tells you that may be an area where that can be done. You can earn a liquidity premium there, and that's what we're looking for. Are there no new ones since 08? I'd have to check, but we have a bunch of them.
Funds data doesn't show any increase in the amount outstanding.
Yeah, I'd have to. I'm sure know the data better than I do, but we will have all the data. So I'm not going to give up any organs though.
All right, I'm gonna call it there. We'll move to our third panel. Thank you, gentlemen.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.